In these track and trade spreads quick start videos, we're going to answer the question, what is a spread? And then we'll demonstrate exactly how to put on a spread using Track and Trade's Live Spreads plugin. A spread is the buying of one commodity and the selling of another similar commodity or same commodity but different contract month. In other words, putting on a spread position is to speculate that one contract will outperform another. It involves a long position in one futures contract and a short position in another or similar futures contract, either within the same market or a different market. There are basically three types of spreads. There are intra-market, or what we like to refer to as futures time spreads, which is the same commodity but different contract months. For example, December live cattle against February live cattle. There are inter-exchange spreads, which is buying and selling across two different exchanges, such as Kansas City wheat against Chicago wheat. We also have intermarket, or what's known as commodity spreads, which is buying and selling two different but similar markets against each other, such as unleaded gasoline against crude oil. But this brings up a very good question. If I'm buying one contract and I'm selling another contract, how do I profit? Am I not making as much on one as I'm losing on the other? That's a zero-sum gain, isn't it? To some extent, yes, but there are exceptions. Let's take corn, for example. In corn, we generally spread between two different crop years, last year's crop, which is currently in storage, and a known quantity, against this year's crop, which is still in the growing stages, and is usually much more volatile. Not to mention, we also simply have the passage of time, and as we all know, time is money. So basically, when we put on our corn spread, we're not really buying or selling corn outright, like we do when we trade an outright futures contract. What we're actually doing is trading the difference between the two corn contracts. Because of this, our risk is significantly curtailed. The exchanges recognize this and will generally give us a break on margin. As a side note, many of you might be familiar with the Forex market. Let's think about this market for just one moment. Each chart you see within the Forex or foreign currency market is a spread chart. That's right, when trading Forex, you're trading spreads. For example, if we're trading the EUR-USD market, we're not trading the euro, nor are we trading the US dollar. We're actually trading the spread, or the difference between the two currencies. If the price of the euro increases over the price of the US dollar, the chart rises. If the price decreases over the price of the US dollar, the chart falls. This is exactly the same thing we're doing with our traditional commodity contract. If the price of one commodity increases over the other, the chart rises in price, or is considered bullish. If the price of the commodity falls in relationship to the other commodity, our chart falls, or turns bearish. If we reverse the market, the order of the market that we're spreading against, we get the opposite effect. For example, if we take a look at the Japanese yen in the futures market, you'll notice that the chart is bullish. But when we take a look at the exact same market through the eyes of the Forex market, we see that the same market is in reverse, or upside down, and is bearish. This is simply because we are spreading the dollar against the Japanese yen in Forex, and we're spreading the Japanese yen against the dollar within the futures exchange. This is determined by which market you list first in your spread, which goes back to our traditional commodity spread, where we generally will buy the close-in month and sell the further out month. By sticking to this general rule, your spread chart will look the same as everyone else's, bullish or bearish, and won't be considered upside down.